Dividend investing sounds like a smart strategy. Buy established companies, generate passive income, and live off the cash drinking pina coladas on the beach. It's an investing strategy that sells well, which is exactly why so many finance influencers promote it. However, the truth is that dividend investing is often overrated, inefficient, and in many cases even harmful for your long-term returns. This is why in this video I want to break down the myth and at the end of this video show you a different approach that you can take over dividend investing. If you don't know me yet, my name is Johnny and I spent the last 5 to 10 years in finance roles such as investment banking and private equity, and I created this channel to help you make smarter money decisions. So let's get started. Before we get into why dividend investing is overhyped, let me first quickly explain what dividend investing is. Dividend investing means buying stocks that pay you cash regularly. Usually, stocks like that have a dividend yield that is calculated as the dividend per stock over the price of the stock. This gives you an idea of, what the potential yield would be for a stock that you're buying, right? There are different types of dividend stocks, such as, classic, large, established blue chip companies, such as Coca-Cola, which pays us the dividend. And then there's also real estate investment trusts, or REITs, which are real estate companies such as Realty Income that pay you out regular dividends. A third category would be business development companies or BDCs, such as, for example, RS Capital, just to name a few examples for dividend companies. The nice part about them is that they pay you cash regularly. Some do it monthly, some do it quarterly, and some of them do it yearly. Sounds great, right? But there's a catch, and it's actually a big one. The reason number one why dividends are not as good as you might think is because the stocks that pay out dividends are often matured companies. To illustrate that, let me walk you through a company's life cycle. Every company goes through 4 stages. First, a business goes through some kind of startup phase, where they lose money or they make very little in profit. Second, they go through a growth stage, where the revenue of the company grows significantly. This growth then flattens out as the company matures, just before it declines again. And not all companies decline and die. Some are able to, reinvent themselves and then, they start with a new similar life cycle. As an investor, your goal should be to find companies that ideally are at the beginning of the growth stage. This is because the startup phase is often too risky to invest, because the company still has a high likelihood of failure. However, in the growth phase, the company's business model should already be proven with a clear strategy to replicate what works and grow aggressively. This stage is then where the highest value increase happens, allowing you as an investor to profit from that. However, if you buy dividend companies, you often buy companies in the mature stage of their cycle. Which brings us to the second reason why dividend investing is broken: lower growth. When it comes to increasing the value of a company, you have a couple of levers that you can pull to increase the value. Ultimately, those levers boil down to 3 levers: higher valuations, right? Higher multiples, increasing profitability, cutting costs, increasing margins, and growing revenue, which is scaling the business, like for example, expanding into new geographies, etc. What you should know about these 3 levers is that the third lever, growing the revenue of the business, is usually the most powerful lever. Here's, for example, a McKinsey report that illustrates that. As you can see, over the last 13 years, revenue growth was the largest contributor of value increase. And when it comes down to stocks that pay dividends, they certainly might be, profitable cash generative assets, but they're less exciting when it comes to growth opportunities. This is the main reason why they distribute the generated cash in the first place, right? Because they literally ran out of options to invest that money and grow. Finally, the last reason why dividend stocks are broken is taxes. In many countries, dividends are taxed as income, often at your marginal tax rate, whereas capital gains are only taxed when you sell the stock. In other words, with dividends, you get taxed every year, whether you need the cash or you don't, right? With growth stocks, on the other hand, your gains compound over time, and you decide when to sell and when to trigger taxes. Over decades, these tax deferral effects can compound into thousands, even tens of thousands in extra returns, especially if you're reinvesting and compounding over time. So now that you know why dividend investing is less effective, what should you do instead? Well, in this video, we revealed two major points. First, the best stage to invest into a successful company is in the early growth stage of the company. And second, the highest value creation lever for a business is revenue growth. So why not consider growth investing instead? If this is an investing strategy that interests you, I recommend subscribing to my newsletter to get access to my growth stock watch list. You can find the link in the description below. However, let me also emphasize that the decision whether or not dividend investing is for you also depends on your goals, right? So if you are a more risk-averse investor or retired and you want some extra regular cash income, then dividend investing can be for you. But in general, if you're young looking to invest for the long term, growth investing will likely yield higher returns. If you're interested to learn more about growth investing and learn how to identify attractive growth stocks that have potential to 10x, I recommend checking out my other video. Other than that, I hope you got some value out of this, and if you like the content, don't forget to hit subscribe and see you in the next one.